This year I'm going to do something a little bit different. I'm going to talk a little bit about FundThrough, and instead of diving deep into our operations and how we're doing, I'm going to peek under the hood of a different part of our business, which is our funding structure, because I understand that this year we have a lot of investment advisors in the room or online, and I thought maybe that would be interesting. So if we can dive right in, FundThrough's mission is to empower small businesses to thrive. So if we can just go on to the next slide. I should do that, not ask somebody else. Sorry about that. It's to empower small businesses to thrive, and we do this by reimagining invoicing so that small businesses can get control over their cash flow. One of the number one challenges for small businesses is cash flow. And you can imagine if you're selling something to a large customer, whether it's a good or a service, oftentimes your capital is tied up in the goods that are on the shelf at Walmart, and oftentimes Walmart will have already sold the goods before they pay you. So your cash is tied up, you have to pay payroll, you have to pay other suppliers for more product to be able to sell more, and that gap gets wider and wider as your payment terms get wider and wider. And we just don't think that's fair. We don't think it's fair that much larger customers basically use their small suppliers like a bank when they don't necessarily need to. So we provide instant payments for businesses who sell to much larger customers. And an interesting way of, an analogy here, an interesting way to understand what it is that we do is to think about a credit card. If you are a small business and you are selling to other small businesses, or you're selling to consumers, you can deliver the good or perform the service and then send an invoice, and in the invoice you can put a link to your credit card system so that you can accept credit cards. And most of the time your small business customer or your consumer customer will pay you by credit card. And if you think about all a credit card is a way of getting paid faster. And for that you pay a fee to the credit card company. You might pay them 2 to 4% of the transaction value for the ability to get paid faster. Well, as you can imagine, Fortune 500 companies, large private companies, the government will not pay you by credit card. They just don't have the capability to do it, nor do they have the interest in doing that because they like to hold on to their cash for a longer period of time, as long as they can, and they have the power to be able to do it. There's a power dynamic, between them and their small supplier. You can think about FundThrough as effectively being that credit card mechanism for small businesses who sell to customers who can't or won't pay them by credit card. And we charge basically the same amount that a credit card would charge you, but we give you that convenience. So why would you use our services? Well, for one, it provides you with capital today to be able to invest or to be able to cover your payables, your expenses. And I'll often use this from a finance perspective. Any way that you can get paid faster and invest that money to make more money, it becomes an NPV positive project, and you should do this. It makes economic sense to do it. And if not, then you shouldn't use FundThrough. What's unique about FundThrough is how we go to market. So we are a tech-enabled invoice factoring platform, and there are three distinct channels, three distinct kinds of partnerships that we have, and then there's a fourth channel which would be direct or through referrals. But I wanted to talk for a second about the three types of channels that we have with our partners because they are different. And one of the selfish reasons that I want to raise this with the group and scream it from the rooftops is that it may trigger in your mind, oh, wait a minute, I have X client or X neighbor or X who works at a company that might be able to be a partner for FundThrough. And you'll see at the end, because I'm a very selfish guy, I have a slide with a bunch of asks on there, and one of them is this. So we've got three different kinds. We've got the embedded partnership, and there's a company out there, for those of you who might know, back in the olden days, there was a Canadian small public company called Cortex, I don't know. Yes. So Cortex was acquired by a U.S. company as part of a roll-up and rebranded as Inveris. Inveris has a bunch of different divisions, and one of those divisions is what they call a business automation division, and that is accounts payable automation software. If you're a small business selling into the energy space, specifically oil and gas, either in the US or in Canada, and you're the person who's drilling the holes or hauling the rocks or building the pipelines or providing the catering to the sites or cleaning the sites or whatever it is, you will most likely be using Inveris to receive your purchase orders or your work orders, and you'll be required to issue your invoices through that system. And through that system, you can see the different status changes of the invoice. You can see that an invoice has been uploaded, it's been received, it's been accepted, it's been approved for payment, and finally it's been paid. This is brilliant for a factoring company because it gives us most of the data that we need to know that we can fund an invoice. I need to know that the invoice is real, in other words, that you've done what you're supposed to have done, that the invoice is going to get paid, and it's going to get paid to the right spot, and each of those statuses that I've just talked about within the system allows you to do that. So we partnered with Inveris, and over the years have gotten deeper into integration. Some of the previous companies presenting have talked about APIs. Well, we have an API with them so that when you issue an invoice, a button pops up and it says get paid now. You click that button through an API, we get all of your data, so we don't need to get anything manually, and we can almost immediately make a decision to be able to fund it. And you never have to leave your workflow, which is a really important thing for a small business. You can continue doing what you're doing. These embedded partnerships, where we are embedded in the software, is a really valuable way for us to go to market because it's easy for the small business owner, because it's profitable for the partner. We typically have a rev share agreement with them. And for us, it's lower risk and higher margin. So that's one type of partnership. I'm going to skip to the third and then come back to the second. The third type of partnership is accounting software or invoicing software. As you can imagine, this one might be a little bit more obvious. As you can imagine, if you are funding invoices, wouldn't it be nice to be in the software where that actually generates the invoices? QuickBooks is one of the largest softwares for small businesses across North America to generate invoices. Within Canada, we have a de facto exclusive partnership. I say de facto in that it's not contractually exclusive, but we are the only ones, given the tech development that was required and the deepness of the relationship, for us to actually be integrated directly into the platform. So if you have any clients, friends, neighbors, anybody who uses QuickBooks Online, sells to other businesses, they will maybe, hopefully, likely have seen FundThrough within their dashboard, and they can click that button and get paid. I can now skip back to the second type of a partner, which is new for us. We said to ourselves, okay, our business is funding supplier invoices to large customers. And what if we then said, let's go the other way? What if we partnered with the actual buyer to be able to offer this to all of their suppliers? We eliminate some of the riskiness of what we are doing at FundThrough as a factoring company, in that we don't have to worry about verifying the invoice because we know the invoice is real. We have a partnership with the person who's going to be paying the invoice. And we don't have to worry about what's called dominion of cash. We don't have to worry about the small business getting paid, going off and doing something with that money, because that's a very natural thing when a small business owner sees money hit their account. Even if it's not their money, that money's often gone because they're spending it on something else. We don't have to worry about that because we have a partnership directly with the buyer who's going to be paying it. Last year, I guess in December of 2023, those of you who live in the Toronto area may be aware that Mastermind Toys went through a receivership process, a CCAA bankruptcy process, and came out the other side with a new ownership and a clean balance sheet. Turns out that the new ownership, we had a prior relationship with funding some of their other portfolio companies. So I called up the owner and I said, well, hey, I have an interesting proposal for you. I can imagine coming out of a receivership that a lot of your suppliers had shipped inventory to the previous company and now are unsecured creditors. They're not going to get paid anything on that inventory. So you have a trust problem with your suppliers. And it's likely that you're going to be on COD, cash on delivery, with a lot of your suppliers for a while. What if we partnered with you? Because I know you have a clean balance sheet, and I know you as an ownership group. So I'm pretty confident that this is not going to fail, at least not in the short to medium term, and probably never. We can then offer this to your suppliers so that you can get the terms that you need with them. They can get paid right away, and they have confidence that they know that they're actually going to get paid. They thought it was an interesting idea. We thought that there was a way to do a pilot. When we do these types of pilots, we tend to do them not necessarily tech-enabled. Even though we are a tech company, we like to test things out very quickly before we build a black box, then hope people will actually buy it. So we did. We did a partnership with them, and they hosted a meeting like this with all of their suppliers in January of last year. And I was asked to attend and present 2 slides. They presented, a whole vision of where we were going and why you should support us as suppliers. And we're talking about the small toy suppliers all the way up to Mattel and Hasbro and Lego and Spin Master and names that you know. But there's a long tail of smaller suppliers as well. After their presentation, they had a Q&A section. And then after the Q&A section, they said, stick around for a little bit. And I walked away from the podium, and sure enough, there was like a lineup of suppliers who wanted to talk to me. I became the most popular guy at that presentation. And the reason was suppliers came to us and said, this is effectively the same as like credit insurance. I now don't need to worry because I can't get credit insurance on a newly coming out of insolvency company, but I know I can get paid with you, and I would have paid X percentage for credit insurance. I don't mind paying the fee to you. So a light went off. We're like, okay, this is an interesting channel for us. And we now, we worked with them. It's a highly seasonal business, as you can imagine. Fourth quarter is where, these toy retailers, for the most part, make a lot of their money. And it was a highly successful partnership. So that's a new thing for us, being on the buyer side. And I wanted to put that out there to get some thoughts going. We like to take inspiration from SpaceX. So if you look at where we've been, we're now coming up on 10 and a half years. In June, it'll be 11 years. These are Raptor engines for their rockets. And you can see, yesterday, several years ago, this is what it looked like. We had a lot of mess in the background. You can almost think of the swan gliding along the surface, but paddling really hard underneath. And we were paddling really hard underneath to get things going. And our goal for the last year has to become much more efficient. And so we are now here. And our goal for tomorrow, next year, is to get to here where things are very efficient. There's leverage in our P&L so that when we grow revenue, we grow profit significantly greater because of the expense lines in our business. So I want to share that with you. Now, where does our funding come from? We have 2 buckets of funding, and then we've got sub buckets. One bucket of funding is our equity dollars, where we raise money to fund growth and fund operations and keep the business going. I'm not going to talk about that today. The second part of what we have, though, is our debt. For us, our inventory that we are selling, we're not selling widgets, we're selling money. So we need lots of money, and we need it in different forms. So we have, this is a small slide. I don't know if we're small words on, or a lot of words on the slide, so it might be hard to read. But the way our structure is we've got a senior lender called Northleaf Capital, which is a Canadian company, who have been great partners of ours since 2020. Actually, we did a deal with them. Originally, it was a $50 million US facility, and it was the first time they ever did a deal where they had never met the people because they couldn't do live diligence in the summer of 2020. So I'm sort of proud that they trusted us enough that they could do the deal without looking in the whites of our eyes. But they did. And we've now since grown that $50 million facility. It's now a $125 million facility. And as we grow, the rates come down, the advance goes up. So you can imagine for every dollar that we advance, we need to come up with effectively $1 to fund, right? That's our inventory. So the way we do it right now is that we have the senior lender, which will fund about 89 cents of that dollar. And then we have what we call sub-debt. And that's what I thought was an interesting conversation to share with you about what that sub-debt is. So our sub-debt currently is funded through family offices, high net worth individuals, some small institutions, and they sit below Northleaf. But what's interesting about a collateral perspective, Northleaf is done through a bankruptcy remote special purpose vehicle funding, so it's sort of off balance sheet through what's called an SPV. Whereas the sub-debt folks have security over FundThrough Inc., which means that they have security on everything that Northleaf doesn't. And Northleaf only has security over the invoice itself up to the amount that it's owed. So the sub-debt holders have security on the remainder, the 11% that's not funded from Northleaf, plus anything that doesn't match Northleaf's borrowing base, because we have a lot of concentration limits and geography limits and industry limits and all these kinds of things. So even though they have a headline advance rate of 89%, the effective advance rate will be something much lower than that. Still good companies that we're funding, they just don't fit in the borrowing base. So the sub-debt holders have collateral over that, as well as they have first security over FundThrough as an entity, the technology, the partnerships, the IP, all the things that we've generated over the years. So that's an important thing to recognize about how we operate. We've been doing it this way since 2014 when we launched. Obviously no sub-debt holder or senior lender at all has ever lost a dollar. We've never missed an interest payment. It's all gone well. And because we're funding short duration assets, there's an opportunity for liquidity if somebody so chose. And of course, because this is an asset class that is different than, say, things that are out there, bonds or other opportunities out there, it sort of is uncorrelated and can enhance risk-adjusted returns for investors, and that's why a lot of them like this. And of course, they get monthly reporting. Every sub-debt holder every month gets a detailed report about what collateral they have, how it's done, how it's performed in that last month, as well as what you have earned and what's collected, what's still outstanding, that kind of stuff. So that's a little bit about the capital structure of FundThrough and how we operate. This is the selfish part. I would love to ask for help, and I'll start with the thing at the bottom, which is FundThrough, talking about FundThrough. I go to conferences and I talk about FundThrough, but we are not on bus shelters. We don't have a blimp yet, and we don't take out Super Bowl commercials. So most people don't know us. Within the spaces that we operate, the oil and gas space and various others, we are fairly well known, but broadly we're not. So we oftentimes don't know what we don't know. So I encourage you, anybody that you know, just mention FundThrough and what we do and have them come. And if anybody wants to chat, I'm very happy to always talk. And then, of course, if you know of anybody who might be able to use our services, somebody who waits a long time for their payments to come in from large customers would be perfect. What's beautiful about the way the FundThrough system works is that you don't need to fund all of your receivables. You can pick and choose which customers you want to fund and pick and choose which invoices within those customers that you want to fund. You use it when you need it. You only pay for it when you use it. There is no cost to get on board. That's my little pitch. And then, of course, I talked earlier about partners. And, of course, investors, sub-debt equity, we're always looking for new investors. And talent. We are, as we become more efficient, we are growing our team much less. Actually, we've been shrinking our team a little bit, but we're always interested in talking to good people and finding places for good talent. So that's the end of my formal presentation, and I'll open it up to questions. Sure.
Just curious on the subordinated debt, out of curiosity. So if it's redeemable in 90 days, I assume the duration match is pretty good because your asset duration is so short?
Yeah, that's exactly right. So what the technical thing is, you're matched against invoices. It is redeemable when those invoices, like we just won't recycle that capital. So if it happens to take longer for those invoices to get paid, then it'll take a little bit longer for you to get paid. But the point is, it is short duration. Any other questions? Wow, it was so self-explanatory. Brendan.
All right, so I was going to ask about the subordinated debt, but obviously you were putting a plug in there that if people want to invest directly with you, you have no problem plugging your own stock during
My contact information is on the last slide. Feel free to reach out. Happy to discuss. This is not a solicitation.
Yes, fair enough. So my question is, given that you are on these different sites, the accounting sites and the different sites, people are asking you for money.
Yeah.
How do you control the amount of inflow, outflow? Because somebody's at home clicking, I'd like $10 million, please.
Oh, right.
How does all that work?
Right. Well, so at the most basic level, they're clicking that button against a specific invoice. So the invoice dollar amount is the cap of how much they would be able to get access. And of course, it's not necessarily that they would get 100% of that invoice dollar amount. It would be, is that invoice good? And if it is good, then they would get the amount. But they're clicking on individual invoices for us to be able to do it. It's not that they are requesting a generic dollar amount.
But the invoice, sorry.
Yeah, but what we do say, what's interesting is that we will say to you, you have unlimited access to capital. You go and do what you do best and invoice. So we don't give you a line limit. Come back when you have an invoice and we will fund that invoice as long as it's a good invoice.
But how do, in aggregate, lots of people using this, how do you control the amount of money that FundThrough puts out? Let's say 100 people, 100 different companies all decided they wanted $100,000 on a given day. You're putting out $10 million on a day.
Yeah, so we draw from North, we have opportunity to draw from Northleaf on a regular basis, so on sort of a daily basis. These things don't typically happen. We don't believe that speed is a differentiator here. So these things don't typically happen where somebody pushes a button and wants the money, that hour. So that we have some buffer where we always have cash on our balance sheet to be able to do, and then we can draw from Northleaf and put it into our borrowing base. Yes, Mark.
What percentage of bad debt?
Yeah, give it.
What percentage of bad debt?
Yeah, so as you can imagine, because we are focusing on high quality customers with a short duration product, and we are ensuring that the work has been done and we are not taking performance risk and we're only taking time risk, our bad debt is like in the sub 0.5%. So I can't remember exactly the number over how much we have funded over the last 10 years, but it would be millions of single digit millions that we've lost against billions that we've funded. So that's good. And it's getting better. I mean, we've taken our lumps. The thing about this business is that it goes like this a little bit. So we have taken our lumps, and we've come out quite strong.
What's the largest amount you've allowed to go out?
Yeah, the largest that we have ever funded was actually several years ago, which was about $20 million Canadian. And the reason we got comfortable on that amount, it was a large percentage of our book at the time, was given the direct relationship that we were able to establish with the payor, the end customer, as well as with the client. Actually, it was a client that came through the Inveris system. Now we have regular clients who have $5 to $10 million outstanding. Our sweet spot is in the $250,000 to $500,000, but we have clients that are much higher. If they go out beyond our concentration limits within our borrowing base, we've now established a partnership with a funding source in the US that's called a participation partner, where we would participate out anything above. And they love doing it because it's not like we're trying to hive off some risk to them. We want as much as we could possibly get of exposure to any of those particular clients, but we just can't within our borrowing base, so they will take the excess. So there isn't really a limit if anybody's thinking about size. We can always find a way to get it done. Yes?
You had mentioned the U.S. in passing. You mentioned QuickBooks Canada. What is this a Canadian operation or the U.S. or both? And where would the growth really you see coming?
Yes, so about 85% of our business is in the U.S., even though we're obviously based in Canada. The partnership with QuickBooks is only in Canada. We do not have a partnership yet. We just seem to be on their radar finally in the U.S., but I don't know where it's going to lead. But most of our funding is in U.S. dollars, and then not surprisingly, most of our growth will be in the U.S. So that 85-15 could very well turn to 95-5 by a couple of years from now.